chapter 10. I think I'm going to try to do chapter 10 and chapter 11 both tonight, and then we'll move on to business income starting on Monday. What did you think of the videos last week? Were they useful, entertaining, kind of silly?
Entertaining.
They were a little different than what we've been doing.
I think it was good.
Okay, so number one, I'll begin, and then we'll move on to Dimitri and so on. Okay, so Preston and Sue are married. They have 2 qualifying children, ages 10 and 17, that file a joint tax return. Preston's wages were $21,775, and Sue's wages was $3,425. Sue also received unemployment compensation of $3,240. They had no other income. What is their earned income? For purposes of the earned income credit. So the earned income is not going to count the unemployment. It's just going to be Preston's wages plus Sue's wages, and that should be 25,300. No, 25,200. So A. Okay, and then Dimitri.
Follow 28,440. B.
Yeah, because in that case we're going to include all of their income, including the unemployment compensation. So their total income, adjusted gross income, is 28,440. And so then Dan, what is their earned income credit?
D, 6164. 6100.
Well, not sure. Let me check. So 6, it's not.
No.
So how do we figure that? Well, first we have to look up their earned income in the chart, in the earned income credit table, which that's in book 3. If you want to borrow one, I can. Okay, so we look up their earned income in the table, which was 25,200, and for married filing joint with 2 qualifying children, that was 6,164. But then we also, because their adjusted gross income is higher than their earned income, we have to look up their earned income also in the chart, or their adjusted gross income in the chart. So 28,440. Look across. I also get 6,164. So perhaps you were right, and 28,440 is 5,708. You see where that comes from now?
Yeah. I just looked at the,
You looked at the earned income.
yeah, it's the adjusted gross.
Okay. Yeah. Remember, if the adjusted gross is higher than their earned income, you have to look up both and take a smaller amount.
They're on the downslope then with the 28,440.
Yes. Okay, Mercedes.
Wendy, age 32, is married and lived with her husband and their son, age 13, until August, when, I'm not sure how to pronounce her husband's name.
Dion.
Dion moved out of their apartment and will not be filing with Wendy. Their son continued to live with Wendy. Her wages are $23,259. Wendy is eligible for earned income credit. C.
Unfortunately, it's gonna be D. Because remember, if you're married filing separately, you can only get earned income credit if you lived with your spouse, if you did not live with your spouse at all during the last 6 months of the year. So she is not eligible for earned income credit. The only way they can get earned income credit is for them to go back and file a joint return, which they still can if they're married at the end of the year, because they're married at the end of the year.
So neither one of them can get earned income and count the child?
They can, one of them can get child tax credit, but neither one of them can get earned income credit. That's right.
Because they didn't live together the entire year.
Because they did not live apart for the entire last half of the year. So if your filing status is married filing separately, then you have to live apart from your spouse the entire last 6 months of the year. So from July 1st all the way through December 31st.
Do you expect that rule to change?
No.
It's certainly odd, the last 6 months versus the first 6 months or middle 6 months.
You know, that's been the rule since forever, since before I've been doing taxes. Okay, and then number 5, to be eligible for the earned income credit, what is the limit on investment income? And the answer is A, it must be less than 10,300, or it must be 10,300 or less. So this is one of those times where they try to trick you, because sometimes if you're exactly on this dollar amount, you have to remember whether it's less than or equal or less.
But technically, if you had a penny over, then you pretty much.
Yeah, if your investment income was exactly 10,300, it looks like you would still qualify for earned income credit.
But
If
if
you
you're
were
10,300
over,
and a penny, then you may not.
right. Right, well, then we would round to the nearest dollar, so you get,
Yeah,
49
cents
cents, yeah. Mhm.
Or 49 cents a little.
Yeah. Okay, Dimitri, number 6.
Earned income credit can be claimed when your only income is from interest. False.
False.
Earned income.
That's right. And then number 7, Daniel?
For EIC purposes, your niece or nephew can be a qualifying child.
Sure. Yep, any of those relationships, your descendants, your brother, sister, and their descendants. Okay, Mercedes.
You must have earned income to claim the earned income credit. True.
Yes, that is true. Number 9, the earned income credit can be taken for a niece who lived with you for 9 months of the tax year. That's true. The residency requirement is only more than half of the year. And Dimitri?
You must claim a child as a dependent to qualify for the earned income credit. True.
I think that is technically false, because in the case of where you've signed Form 8332, you can actually let your spouse or your ex claim your child as a dependent, but you still claim that person as a qualifying person for earned income credit.
What's that phone number again?
8332.
It was the one where you give it to the non-custodial.
Yeah, yeah. Remember the 8332, so there are 5 main tax benefits for claiming a child. There's the child tax credit and the additional child tax credit. There's head of household filing status. There's earned income credit, and there's child and dependent care credit. So those are your 5 major benefits for claiming a child. Or if they're over 17, this could be or other dependent credit. But when you sign a Form 8332, that goes to the non-custodial spouse. But these stay with the custodial spouse.
Now, even if you don't have a kid and you only make like, what was it, $10,000, you still get earned income credit, right?
Yes. As long as your income in 2022, it would have had to been less than 16,480. Or married filing generally would have had to been less than 22,610.
And that's only in the case of the form, right?
Hmm?
That's only in the case of that actual form.
Right.
Otherwise, it's not split up like that, right?
Right. So if there's no 8332, then all 5 benefits go to the same person. So it could be you, the custodial parent, or it could be, in some cases, the grandparents or the aunt or uncle, but they all go to the same person. The only time they can be split up is with that 8332.
You can claim the earned income credit for a cousin age 10 who lived in the home for 8 months. False.
False, because cousin does not meet the relationship test. Okay, great. Okay, let's move on to chapter 10. Chapter 10 starts on page 301. And these are our tax benefits for education. We have 2 main tax benefits for education. One is called the American Opportunity Credit, the other one is called the Lifetime Learning Credit. We'll also talk a little bit about the minor benefits for education, like education savings accounts. Way back in chapter 5, I think we talked about being able to use your savings bond interest tax-free. That's actually a really, really minor benefit, so we won't restate it here. Okay, so these are the 2 main benefits: the American Opportunity Credit and the Lifetime Learning Credit. And the easiest way to remember and distinguish these is that the American Opportunity Credit is for undergraduates. It's intended for undergraduates in their first 4 years of college, so post-secondary education. And the Lifetime Learning Credit is for everybody else. So this would be at least half-time students, and this would also include part-time students. It would include people who are just taking classes for general job skills. It includes people who are in grad school or post-grad school. So this is just everybody else, and this is for your typical undergraduates, 4-year students.
So, if someone basically went and got a bachelor's,
Mm-hmm.
and in the end it was pretty much useless, and they went to get a different undergraduate bachelor's program, could they use it the second time around if they didn't use it the first?
No. No, you would only get the American Opportunity Credit. One of the questions that is asked is, do you already have a 4-year degree? If you already have a 4-year degree, you can't take the American Opportunity Credit anymore.
Even if you didn't take it the first time around?
That's correct. Mm-hmm. Okay, so you can claim a credit for higher education expenses for yourself, your spouse, and your dependents, as long as they're attending an eligible post-secondary educational institution during the tax year. So, education credits, the American Opportunity Credit, we'll find out, is part of it's refundable, part of it's non-refundable. The Lifetime Learning Credit is non-refundable. And we'll talk about some general overall rules that apply to both of these credits, and then we'll talk about specific rules that apply to each of the 2 individual credits. Okay. Your credits are always going to be based on your qualified education expenses, and That includes whatever you paid for during the year, and it can include anything that you paid during the year for the following semester, or any academic period that starts in the first 3 months of the following year. So if you paid your spring 2024 tuition by December 31st, 2023, you can count that for your education credits for 2023. Obviously, you can't count them for both, but you might have enough expenses next year to be past the limit anyway. Okay, so to claim either one of these credits, you must, this used to be optional a long time ago, but now you must have Form 1098-T from your qualified eligible educational institution. And the 1098-T, it usually does look like this. It's, we don't see many substitute 1098-Ts, in other words. And it's formatted like a lot of tax forms are. Background information on the left. This would be the filer or the college's name and EIN, and then the student's name and EIN, which is usually a social security number. Here we'll see the payments received. Boxes 2 and 3 are not used anymore, they're blank, they're still there for historical reasons. Box 4, we won't see very often, but what that is adjustments made for a prior year. That is, for example, if you got some expenses reported to you, like on your maybe your 2021 1098, and then you were refunded some of your tuition, maybe you dropped some classes or something like that, those refunds would be counted as adjustments. And in that case, you would have to refigure your prior year's education credit. That's pretty rare, so I don't think we'll go into that in any detail. Number 5 is scholarships or grants. And the general rule is for scholarships or grants is scholarships and grants are tax-free as long as they are used to pay for qualified tuition and related expenses. So sometimes we'll see scholarships and grants be more than someone's tuition and related expenses, because your Pell Grant and other grants can be, you can also use that to pay for your room and board and other housing expenses.
So is this only for the student to take the tax credit, or is this for the parents potentially too?
No, remember back here we said that you can take education credits for yourself, your spouse, or your dependents. So if your student is a dependent, then it's the parent who claims the education credit, or whoever claims them as dependent claims the education credit.
Okay. So it seems like 95% of the time it's the parents taking it for their kids.
Exactly. However, this 1098 will still be issued in the student's name and social security number. So we'll often have to try to get the parents to get their children to find this form. If you're in the University of Alaska system, you can go to your student online portal and look for tax forms, and you'll be able to find this.
So can a grandparent who's paying for the tuition of a grandchild take the credit or not?
Only if that grandchild is the grandparent's dependent.
But if they're simply just covering the tuition, not in a typical sense that they're dependent, then
Doesn't it just be a nice grandparent?
No, only the person who claims that child as a dependent can claim the credit.
Gotcha.
Okay. We'll talk more about how we can strategize with this scholarships or grants, because most scholarships or grants will say that you can use this money for your books and tuition, or room and board, or other living expenses. And but if you use it for living expenses, it's taxable, and if you use it for tuition and related fees, it's non-taxable. But the education credits are based on how much your out-of-pocket expenses are reduced by your non-taxable part of your scholarships or grants. We'll see why in just a few minutes why that's why that discussion is relevant. Then down here in box 6, we have adjustments or scholarships or grants for a prior year. So that'd be basically if they had to claw back any scholarships from a previous year, you may have to refigure your taxes from that previous year.
So if you signed up, you gotta pay, but then you dropped out, and you basically had to refund it or something like that.
Yeah, maybe your scholarship said you have to be a full-time student for the whole semester, and you drop down to 9 credits, and they say, well, you have to pay your scholarship back, or something like that. Box 7 is a checkbox which says that it may include amounts paid for the following academic year. So this is a 2022 form. This box would be checked if some of those payments were for the spring 2023 semester. And then 8, 9, and 10. Box 8 is if you're at least a half-time student, which is important if you want to take the American Opportunity Credit. Box 9 is if you're a graduate student, which means you already have a bachelor's degree or equivalent 4-year degree, which means you can't take the American Opportunity Credit. And box 10, I don't know what that is. I've never seen that number filled in before. It says insurance contracts reimbursed. I don't know what that is, so I'll have to look that up if it ever comes up. Okay, so in order for you to claim any education credits, so first of all, if you must not be able to be claimed as a dependent on someone else's return. You cannot be married filing separately. You simply do not get this credit. Your adjusted gross income has to be under certain limitations, and that's going to be summarized on the quick finder cover that I passed out a few weeks ago. So here at the bottom, we see that for American Opportunity Credit, for both American Opportunity Credit and Lifetime Learning Credit, our phase-out range is $160,000 to $180,000 for married filing jointly. So that's and half of that for any other filing status.
That's the phase-out timeline? And within
Yeah,
that range?
that's the phase-out range. And remember, once again, the way we read this is if you are, this is all based on AGI. If your adjusted gross income is less than the smaller figure, you get the full benefit. If your AGI is more than the higher figure, you get no benefit. And if your AGI is in between those two, you get a partial benefit. And then finally, these credits are not available to non-resident aliens.
Why is the married filing separately an issue for this one?
Married filing separately is an issue mainly because of the AGI rule. So let's imagine that one spouse makes $140,000 and the other spouse makes $50,000. Well, if they filed jointly, they would just be outside the range. They'd be over the 200 AGI. But if we took the spouse who made less, they would be under the range and would hypothetically be able to take the full American Opportunity Credit. But that's not the intention. The intention is that if you take the American Opportunity Credit, it's going to be based on your whole household's income.
What's generally the value of the credit anyway? I saw 1,500 something in there. Is that the total amount of the credit?
The full amount of the credit is $2,500 per student
Per year or
per year. Per student for the American Opportunity Credit. And for the Lifetime Learning Credit, it's up to $2,000 per year per tax return. to 2,500 per student.
Up to 2,500 per student per year. And the LLC is, you said 2,000 per tax return per
Per
year.
tax return per year, regardless of the number of students. Basically, they eliminate a lot of these credits for married filing separately because they don't want people having to play these games with, you know, reallocating their adjusted gross income and figuring it multiple ways. Generally, the idea is if you're married, you should be filing a joint return. Or at least the way the law is written, it's encouraged, highly encouraged you to file a joint return.
Basically, they encourage you to miss out on certain benefits if you don't.
Correct. Yeah, because just if we look at your tax return and you're married filing separately and you make 70,000 or 78,000 and you're under the phase-out threshold, we don't know whether you would have qualified or not on a joint return without looking at both returns. So to make it simpler, we just say you don't qualify, just file a joint return and then you can qualify.
I'm curious, for instances where someone might be nearly getting a full ride, or they're below that income threshold, they're getting like Pell Grant and other stuff, and they might also be getting pretty much all the costs covered, at least from the tuition standpoint, maybe not the room and board standpoint. Does a parent still stand to take a credit for anything at that point, really?
Yes, yes, and we talked about choosing, you can choose part of your scholarships and grants to be taxable income in order to increase your education credits. So we'll talk about that in a little bit in just a few minutes, but yes, even if you have a full ride, it's often the parents will get a benefit, education credit benefit. Alright, next, the taxpayer and spouse and the student must all have valid identification numbers by the due date of the tax return. And so who's an eligible student? That was on the previous slide, but it is basically, once again, it's you, your spouse, or your dependent, and who must have qualified education expenses and be enrolled at an eligible educational institution for at least one academic period during the tax year. So they can be enrolled in the spring semester and then graduate, or maybe or they don't have to graduate, they can just not go back, as long as they're enrolled in at least one semester. And then there's this weird rule, which applies only to the American Opportunity Credit, is if a student can be claimed as a dependent, either you or the dependent can claim their American Opportunity Credit. It's almost never a good idea to have the dependent claim the American Opportunity Credit, but it could happen. For example, if you're above the adjusted gross income range, so you get no benefit at all, then maybe you can let your son or daughter claim their own credit and get some benefit out of it.
Is it refundable in that case if, say, they have no income really?
No, it won't be.
But if they worked and earned like $20,000 and they had some,
Yeah, if they had some tax bill that could be reduced by a non-refundable credit, to be better off.
so if they worked at least part-time, then it might make sense. If they don't, pass at least the standard, or well above the standard deduction, then they really get the value out of it, right?
Right. So here's an example. Lucy can claim Miranda as a dependent on her tax return. Miranda pays for school out of her earnings from her job. Lucy can claim the credit based on those expenses. It doesn't matter. It turns out it doesn't matter who pays them as long as they're paid. So they can come from Lucy's pocket or Miranda's pocket. If Lucy claims the credit, she can claim all the expenses as qualified education expenses. And if she allows Miranda to claim those expenses, then Miranda will claim all the expenses, regardless of who paid them. So in the case of the grandparents paying for college, it's still going to be the parents, whoever claims the child as dependent, that claims all of the qualified educational expenses, even if that's a gift from other family members. Okay, so this is, and I'm not sure how this rule came to be, but if a student can be claimed as a dependent, so if they can be claimed, but is not claimed, so this is basically the only time in the tax code where the tax rules actually ask you, does someone claim you as a dependent? In almost every other case, it just asks, could somebody claim you as a dependent? We don't care if they do or not, but could they? This is the only time we actually ask, does someone claim you as a dependent? If you could be claimed but you're not being claimed, then the student can claim the education credits. But they still have to check the box on Form 1 that says someone can claim me as a dependent.
So what's the result of this rule then?
The result of this rule is to allow the student to claim the education credit. So if the parents decide, even though they're eligible to claim the student as a dependent, if they don't claim the student as a dependent, the student can claim their own education credit instead of the parents.
Okay, so if say the parents didn't have enough, they already have enough tax credits and stuff that they're basically got their taxes covered, and the student has, you know, some income above the senior deduction threshold, they might choose to do it in a scenario like this. Where they still got their child tax credits and all that, but they allow the student to take the education credit.
Yeah, so it'll be, instead of the child tax credit, it'd be the other dependent credit, because we're talking about college-age children now. So it's going to be a $500 credit. So maybe the parents, maybe their AGI is over 180,000, so they can't claim any education credits, and maybe they're willing to give up this $500 other dependent credit to let their student claim. In this case, it's going to be up to $1,000 in education credits.
Gotcha.
So it could be advantageous for the family as a whole to let the child claim their own credit. But the parents not only lose the ability to claim the credit, but they have to opt not to claim that child as a dependent.
Oh, so they miss out on all the potential tax credits and EIC.
Yeah, they'll lose EIC, but if your AGI is over 180,000, then you're not going to get EIC. So basically this rule is only usually going to be useful when the parent's AGI is over 180,000 or 90,000 for head of household, single, and qualified surviving spouse. Okay, so what are your qualified education expenses? This is tuition and certain related expenses. So tuition and fees paid as a condition of enrollment. So anything that's required for enrollment or attendance at an eligible educational institution. Okay. Related expenses includes any books, supplies, and equipment that are required for class. So if you're taking an English class and you need to buy certain books, certain items of literature, or if you're taking an engineering class and you need a textbook and maybe a laptop, and those are required for attendance, those would all count as these related expenses. But if you buy a study guide, you know, just for your own, to help you with the class, but it's not required for class, that would not count as related expenses. Similarly, if you're not required to have a laptop, but you find it useful for class, that would not count as a related expense. And then student activity fees and similar things like that are included if they're required as a condition of enrollment.
Would someone generally break that down, or would they be relying on the 1098T?
We'll usually have that, being broken or relied on by the 1098T, because this would be, well, this is tuition and those related student activity fees, technology fees, whatever other student government fees, stuff that they throw in that are not technically tuition that you're required to pay. All of that would be on the 1098T, but we could also add in any required books.
So you might add to it, but that's gonna be your starting point, you're not subtracting from that,
Right.
generally speaking.
Right, so the 1098T is going to be your baseline, which you'll add on any books or supplies that they bought, that the student bought. Okay, this is where we're going to break down some differences between the American Opportunity Credit. So for the American Opportunity Credit, or AOC for short, for your course-related books, supplies, and equipment, so this is like your textbooks, your laptop, maybe your, if you're in some kind of chemistry class, if you have to buy some of your own equipment, or if you have to rent equipment. For American Opportunity Credit, it doesn't matter where you bought those books, supplies, and related books, supplies, and equipment from. So if you bought them from a used bookstore, if you bought them directly from a previous student from that class, as long as you can prove that you paid that, you paid them bought them on Amazon, doesn't matter. Those count as education expenses. But for the lifetime learning credit, okay, so these are not required to be purchased directly from the school. For purposes of the lifetime learning credit though, the expenses only qualify if they are paid directly to the institution. So if you buy your textbooks from the campus bookstore, for example, then that would count. But if you bought your textbooks from an outside source, they would not count for the lifetime learning credit.
So the second one, if you do buy, things from the bookstore,
I guess there's a note here saying that buying from the bookstore does not necessarily mean that they're required to be paid to the institution. So I'm not sure 100%.
but you could potentially add that in,
Yes. Mm-hmm.
because the required textbook is at the bookstore, and you go there and buy it, even though it's not maybe on the 1098, it's a separate expense, but it is paid to their facility.
Mm-hmm.
So you, generally speaking, you could add that in, right?
Yes.
I mean, ultimately, I think like 80% of the time, you're kind of forced to buy it from wherever they tell you, whether it's a professor and their work, or their basically class manual that they have printed at the local print shop. But that's basically where the professor sets it up, and you have to go get one there. That would potentially count as well.
No. So, let's see. I'm just going to double check this because I'm not sure this doesn't match what I've taught in the past. But in my experience, they would have, you'd get a syllabus at the beginning of class, or actually before class. And they say you need to have these books, like such and such book, 3rd edition, printed in this year. And you can go to the bookstore and they'll have that. Or you can find it on Amazon and buy it from there instead. Or you can say, hey, you just took this class last semester, can I buy your book from you? As long as it's the same book that matches what's in the syllabus, that's going to count in any of those cases. So, and I don't see anything in the actual rules from the quick finder that says that those, that mentions anything required to be paid to the institution. So I'm just gonna go with if it was purchased directly from the institution. So if you did buy it from the campus bookstore, it would count.
What if it was, like you said, it was an item on the syllabus, but it's not the bookstore that you buy it from, it's the local copy shop that the professor basically just
No,
said.
the local copy shop is not part of the university.
Even though that's what the professor says, except that was my case, I had like at least 2 of these kind of manuals I have to go get for class, wherever the professor basically says, you go get it here.
Yeah,
So-
I've had that happen where the textbook was basically just a PDF file at Kinko's, and the professor said, go down and tell them to print one off.
So,
Oh, I have like full manuals,
Yeah.
like the quick finder, you know, full things that they print and bind for the class.
Yeah.
At a certain copy shop.
Yeah, when I'm
You
talking
go
about textbooks, I'm talking like 600, 700-page books.
so the,
But if that's not part of the university, then it doesn't count.
so the AOC credit would cover it going to Kinko's to get it, but the
Yeah.
LLC would not.
Exactly.
Because, so it would have to be on campus or like a campus print shop that is connected to the campus. So, so that money initially goes back to the institution.
Yes.
Okay, so if it was a campus print shop, then you'd probably be good.
That's where you
If
would
it
have
was
to go
a
with the
private
LLC.
print shop that they set up to, then you
Right.
wouldn't.
Right.
So, pretty much it's the AOC, you can spend the money wherever you need to get your stuff. The LLC, whatever money you spend on your books and your equipment needs to go back into the institution. So if it's not connected to the campus, the LLC will cover it.
Yeah, and we're gonna see this as a recurring theme. The American Opportunity Credit is a lot more generous and a lot more relaxed on its restrictions, as long as you're a full-time student, or at least half-time. The Lifetime Learning Credit is a little more restrictive on what you can count as expenses, but it's a lot more loose on who can claim the credit. And if we're doing someone's taxes and we're adding up their course-related books, supplies, and equipment, we do have to be careful that we're only claiming books, supplies, and equipment that are required for the class and not just appropriate or helpful. Okay, non-qualified expenses in every case includes payments for room and board, even if that's included in your required costs. So I know that many colleges or universities require at least their freshmen to live on campus and allow people in later classes to also live on campus, and they'll just charge them a certain flat amount for room and board for the semester. That is not a qualified education expense, whether you live on campus or not. Other expenses for personal expenses, many colleges will require you to have student insurance if you don't have proof of some other type of insurance, and so that student insurance is not a qualified medical expense, even if it's required. Transportation to and from college is not an education expense, so flying down, scouting out colleges, or even just flying to and from school, or driving to campus and back, parking fees, anything like that, not qualified educational expense. So none of these count as qualified education expenses, even if they're required as a condition of attendance.
Would this kind of stuff generally be broken down in the 1098?
No.
Separated?
No.
So how would one go about?
Well, the 1098 would only include the qualified expenses.
Okay.
But someone, whether yourself or a client might say, oh, look, it only says 6,000 on there, but really we paid 15,000 for school. And you can say, well, let's look at your bills, your itemized receipts, your students' itemized financial statements, and it's gonna say, oh, you know, out of that 12,000 they paid, 4,000 was for room and board, and another 2,000 was for student insurance. Those two wouldn't count. So that would explain why it didn't show up on the 1098. But the 1098 is going to be almost 100% reliable. Everything that's on the 1098 is a qualified education expense. So we're only talking about things that are off the 1098 that people want to claim anyway.
Have you seen parents go so far as requiring their students to produce for them an expense report every quarter or semester?
No.
So they can break down some of these expenses and capture them if they want?
No. Often it won't make a difference.
Because you get maxed out on the credit anyway?
Mm.
Okay.
Okay, and then for other classes that are primarily recreational in nature, so if you take like a weightlifting class or a volleyball class or a fencing class, those are typically allowed if they're part of your degree program for the American Opportunity Credit. So every student has to have a certain number of PE credits in addition to like their other stuff. So that those would count.
So it counts towards your degree as an
Yeah.
elective, then it might be fine.
Right. If it counts toward your degree, then it would count for the American Opportunity Credit. For the Lifetime Learning Credit, though, they would not count. Lifetime Learning Credit also has a restriction that any classes that you take have to be in order to acquire or improve job skills. So if I took a cooking class at the local university and I was not planning to become a chef or a cook, then I could not take the Lifetime Learning Credit for that cooking class. But if I wanted to go and take some accounting classes to improve my skills, those would definitely count.
But in the case of someone that thought they were going to do culinary school and they basically took it for a quarter and then dropped out because they changed their mind.
That would probably count. If you could reasonably, without making someone laugh,
You got a reasonable expectation.
yeah, if you have a reasonable expectation, yeah. Like if I were jobless and I said, oh, I'm going to take some cooking classes and maybe I'll get a job as a cook, and then after a semester I'm like, oh, that's not for me. Well, that was my plan when I took the class, so I could reasonably argue that was, that should count for Lifetime Learning Credit.
Okay.
But here, in my particular facts and circumstances and situation, if I took a cooking class, I probably wouldn't be able to convince an IRS auditor that I was going to quit my job here to go start up a restaurant or something.
Why not?
Do people ever take both at the same time, the Lifetime Learning and American Opportunity?
Yes, you can. You can, but they would have to be for different students.
Right. You can't claim them both for the same person.
Right. Not for the same person, but you can claim them both on the same return for different students. For example, if your youngest child is 19 and is a sophomore in college, and your oldest child is 26 and is in law school, you could claim the credit for both of them. The American Opportunity Credit for the undergraduate and the Lifetime Learning Credit for the graduate student.
And the grad student, in this case being 26,
They would have to qualify since they wouldn't be a qualifying child because they're over 24, they would have to qualify as a qualifying relative, which means their gross income would have to be less than 4,400 or something like that. Or maybe if your child was in college as like a freshman or sophomore, and you had gone back to school for an engineering degree, a postgraduate engineering degree.
You're both in college at the same time.
Yeah.
I understand.
Mm-hmm. Okay, so we talked about this. Qualified education expenses are always claimed by whoever claims that child as dependent. So qualified education expenses paid by the dependent who you claim, paid by you, or paid by any other third party, like a generous family member, are all considered paid by you for purposes of this credit. So you get to claim all the expenses, even if someone else is paying them. But you cannot claim, and this is going to come up and become important very shortly, you cannot claim a credit for education expenses paid with a tax-free scholarship, grant, or employer-provided educational assistance. So we're typically talking about Pell Grants a lot of the time, but sometimes people have other scholarships or grants from other sources. But you have to basically reduce your education expenses by the amount of tax-free assistance you get. And this is the no double benefit rule. You cannot claim education credit for the same expenses that you used for some other tax purpose. So we're talking about businesses coming up in chapter 12 and later. You can claim education expenses as a business expense in some cases, but you can't use those same expenses to also claim an education credit.
So you're saying you can't claim it on your personal as well as on your business?
Well, they're both your personal. Your business is part of your personal return. But yes, you can't claim the same expenses for more than one benefit. The double benefit rule.
Right, so you couldn't claim the child tax credit and say it was a business, or not child tax credit, but education credit, say it was a business expense, it's got to be one or the other.
Right. Mm-hmm. So for example, as an enrolled agent, I had to take 72 hours of continuing education every 3 years. And sometimes I take them through the Liberty Tax corporate system, which they don't charge me for, but sometimes I take them through outside sources. Since I'm an employee, I cannot take those deductions because employees don't get business deductions. But if I were in business for myself, filing a Schedule C or some other business return, I could claim those expenses as business-related educational expenses and deduct those on my Schedule C. It turns out I can't claim them anyway for the lifetime learning credit because those education providers are not educational institutions, which is defined. We haven't seen the definition yet, but an eligible educational institution is any institution that has a full-time faculty and is eligible to participate in federal aid programs, such as the Stafford Loan and Pell Grants.
So that's why the explosion of established schools having a huge online presence for all kinds of online programs and online learning, because then through that established university institution, you could count a lot of that same class that you would have taken through them, counts, take it through someone else.
Right.
Just an online Coursera course provider doesn't.
Right.
Okay.
Right. So, and well, they're not a college, so I wouldn't be able to claim it. But if I took my continuing education through a college, in that case, I would have a choice between lifetime learning credit or an educational expense business deduction.
Oh, I see what you're saying. You can't deduct it.
Right.
And
So like a CPA may get their qualifying education through AICPA, the American Institute of CPAs, or they may get it through their state board by going to a conference and attending lectures there. But the state accountancy board or the national AICPA they're not colleges. They're not there to take on a bunch of students and have full-time faculty and a full-time workload. They're there to just provide continuing education opportunities to their people in their industry. So that's why it wouldn't count for the lifetime learning credit.
Is it generally a wash, taking the credit versus taking the business expense? Are close?
It's going to be probably generally better to take it as a business expense if you're a Schedule C sole proprietor, because it counts against your self-employment income, and it's also a deduction for regular tax purposes. So, but this is important. We did have a client, and I think he's moved on. But we used to have a client who was a business consultant, and he already had a BBA and was going on to improve his marketability, and his his revenues were like $250,000 a year as a business consultant. So he was putting himself through an MBA program while also maintaining his practice. So he had a choice of deducting all that as educational expenses because it was in the line of business he was already in. So he could deduct that as an education expense or claim the lifetime learning credit. And it turned out for him much better to claim it as a business expense.
Basically, all of his $100,000 of graduate studies claimed on the business.
Yeah. And basically his clients were paying for all that because it was, he was making a lot more than he was spending. Okay, so we talked several times about what an eligible educational institution is and why my CE providers, like Liberty Tax is not a college, so even if I did pay for my continuing education for Liberty Tax, I wouldn't claim any education credits. An eligible educational institution has to be an accredited college, university, or vocational school that is eligible to participate in a student aid program administered by the Department of Education. So this is mostly, we only really need to look at this for planning purposes for people, because if they're going to an eligible educational institution, they're going to get a 1098. So we don't have to look anybody up. We used to, because not all colleges issued 1098s, but now they all do. So we don't have to worry about looking anyone up. So this would just be for planning purposes. So if they said, I want to send my child to this college and we're not sure if they would get the education credit, then we could look them up and say, oh, it looks like they are, or it looks like they aren't an eligible educational institution.
If it's an institution you never heard of,
Yeah.
Otherwise, if it sounds like a major university,
Yeah.
or maybe you don't have to go through those steps, right?
Right. So they may say, oh, I want to send my child to cosmetic and beauty school in San Francisco. You're like, I've never heard of that. Let's look them up. And maybe they're in there, maybe they're not. If they're in there, and you go to the Department of Education website, and you can find out whether they qualify or not. And if they're not accredited, won't be in their database, and you can say, well, it doesn't look like that's an accredited school, so you're not going to get any education credit, and it's up to you whether you still want to send them there or not.
Things like that don't count. These like vocational programs don't count for the lifetime learning.
No, they have to be. Well, some vocational schools do qualify for student aid, so that's basically the entire criteria, is that they have to be college, university, or vocational school that qualifies for student aid.
But if it's like a 3-month barber shop, hairstyling, whatever it's called.
Yeah, typically those kind of things like beauty school, barber school, and nail college are not going to qualify.
So you're saying the big one is, can you potentially get financial aid related to it?
Right.
If you can, then you're generally fine.
Right.
If you can't, then usually it's not going to work out.
Right.
In terms of the tax credit.
Yeah, because you're going to seek student aid from all these sources. You're going to seek your Pell Grants and Stafford loans. I don't know if they call them Stafford loans anymore, but you're gonna seek a Pell Grant Stafford loan, and this is basically, this education credit is a third type of student aid that's taken afterwards by putting on your tax return. So basically the requirements for the educational institution are the same. Okay, here we're going to talk about the box 4 that I mentioned before, adjustments for a prior year. So you may have some of your qualified education expenses refunded to you. For example, I think when I was going to school, if you dropped out of class within the first 2 weeks, you'd get 75% of your tuition refunded. And then there was another 2 weeks where you could still get 50%. And if you attended your class more than 4 weeks, you didn't get any back. So maybe that's the case. Maybe you overloaded, maybe you signed up for 20 credits, realized you couldn't handle it, and you dropped a couple of your classes. So you get some of your tuition refunded to you, and maybe you paid that tuition in 2022 for the spring semester of 2023, and then you got all the way through, through the end of January, and you realized you didn't like one of your classes, you didn't get along with one of your professors, or you had too many classes, you just dropped one. So you got part of your tuition refunded to you in a different year than you actually paid it. If it was the same year, they would just net it out. So this is for a prior year.
Oh, it will need to show up as an adjustment? If
Right, it would just be netted out. So if I paid $8,000 in tuition in July and got $1,000 back in September, they would just say the net. They would just report the $7,000.
On the time.
But if I paid $8,000 in December and got $1,000 back the following January, then that difference, those happen in different years. So we would have something in the box 4 that says adjustments made to a previous year. So what that means is that adjustment means that you got a refund of education expenses you previously paid. And that says, because of that, well, it says do not amend that previous year's return because you actually did pay that in that previous year. Because these happen in different years, reporting has to happen in different years. So in that case, what you are going to do is you're going to recompute, and we haven't even talked about how to compute these credits yet, but we will shortly. You're going to recompute your credit based on that updated information. And if the credit goes down, then you have to repay the difference in credit on your next tax return. And that's called education credit recapture. So for example, if I paid a bunch of tuition in 2022 and I got a $2,500 credit, but then according to my 1098, I got a lot of that tuition refunded to me. And so I recompute my 2022 credit, now I'm doing my 2023 tax return. I'm doing the next year's tax return, and it says I got a refund of some of what I paid in 2022. So I recalculate. And it turns out my credit is only $23.50. I don't go back and amend my 2022 return. Instead, I have to add an additional tax
To what you have to pay.
on my 2023 return. Yep. So basically, I do have to repay that credit, but I don't have to go repay it by amending. I just repay it by adding it to my new tax.
And then you can use non-refundable credits to take that tax away, right?
No, that'll actually go on page 2 of Schedule 2.
So for taxes that you have to pay for refunded education stuff, you can't use non-refundable credits and credits to pay for it.
Correct. Yeah, and just to double check, we can pull up a Schedule 2.
So if I did my taxes and it's like this, and say I got a $1,500 refund, but I owed $150 for the education refund, I'd get my tax return, but I still owe $150.
No, it would add on to your tax, and remember, your refund is your total payments minus your total tax. So it'd be counted as part of your total tax. But it would not be subject to any reduction for non-refundable credits.
So my $1,500 refund would technically be $1,350 at that point.
Yeah.
Got it.
So if you did have to repay, would it reduce your credit, your tax or education credit the next year?
No, you can still get the whole $2,500 credit
You
again.
would just still list that 150 due, even if you took the whole 2,500 the following year.
Yes.
Okay.
And I didn't see any other place to put it, so I'm pretty sure it would go here for recapture of other credits. So it'd be a recapture of your prior year education credits. And that part of the Schedule 2 flows down to, if you look at the 1040, it's going to go to your other taxes on line 23 on your 1040, which if you look at the 1040 is the part after you've already taken your non-refundable credits. So it can't be helped by your non-refundable credits. Okay. As we previously noted, your qualified expenses must be reduced by any tax-free scholarships and grants used to pay those qualified expenses. So, for example, not counting anything, any books or supplies or equipment, if someone's 1098T said something like this, box 1 is amounts paid for qualified tuition and related expenses. Maybe it said $14,000. And then scholarships or grants is box 5. And let's say this said $8,000. Then if you counted this as all tax-free scholarships, then the difference is $6,000, and you can claim $6,000 as qualified expenses. If this said maybe instead of $8,000, if it said $12,000, if you counted this as all tax-free educational expenses, you would take the difference and you would have $2,000 of qualified education expenses. But and I think we'll get to this example again, you could count this as, you could split this up into, maybe you want to do 2,000 taxable and 10,000 non-taxable. This is just an example. If you wanted to do that, you would count $2,000 as taxable income on the student's income tax return. but then you only counted 10,000 as non-taxable, so you would get 14,000 minus the 10,000 non-taxable that you would have to reduce your, under this rule, and you would have net 4,000 education expenses.
So is there a ratio, is it like 20% or like, what's the ratio of your actual education expenses that are qualified versus how much you get for the credit?
We'll see that in just a few minutes. Yeah.
And an example like you're showing here, would this usually be something that you would simply do on the back end, or would a student have to actually make a request to their tuition office?
No, this would be something, this is an election a decision you would make on the tax return.
I see.
So this is not something you'd have to ask or even interface with your college to deal with.
Okay, it's just during the tax return, you just choose to treat something a certain way. Okay.
And this is actually gonna have two tax returns involved. This is gonna have the parent's tax return where they're claiming the credit, and the student's tax return where they're gonna end up claiming this taxable income. So it's a good idea for the parent and the student to coordinate and make sure that, you know, whoever's doing the taxes is doing both of their taxes, so that we can potentially run multiple scenarios. Maybe 4,000, maybe this isn't the right choice. Maybe a better choice would be to treat 1,000 as taxable, or maybe a better choice would be to treat none of it as taxable. If we could, you know, if we knew both taxpayer situation, the parents and the students, then we could do a better job for them and get more money for the household altogether.
Have you seen a situation where a student chooses to elect most of it or a significant amount is taxable, and then the following year or the following semester, then treating that taxable on their tax return affects them negatively as far as qualifying for financial aid and such?
No, it doesn't, because counting your, there's actually a question about that on the FAFSA application. Is out of your total income, how much of that was taxable scholarships or grants, because we're not going to count that as your income for FAFSA purposes.
Oh, so they don't count it anyway, so really.
FAFSA won't count it. It'll be counted as taxable income under your tax return, but it won't be counted, it'll be deducted back out for FAFSA purposes.
So a student who, say, is primarily not working full-time and they're just going to college and they're getting most of their stuff covered by financial aid and scholarships, it would actually generally be in the benefit of the student or of the parents if the student elected up to the standard deduction as taxable?
No, that's not a good rule. No, we'll come up with some better strategies when we actually see what all the rules are.
Gotcha.
Okay. Another example we might have, and this is fairly common and is easy to treat incorrectly. Let's say their qualified tuition and related expenses was maybe $5,000, and then the taxable, or their scholarships and grants was maybe $18,000. And that's fairly common, because you can get a Pell Grant that will cover your room and board. You may be a single mother, and the Pell Grant will help pay your rent while you go to school. Or you don't even have to be a single mother, you can just be a single student, and they're going to pay like some of your room and board. Maybe not quite this extreme of an amount, but because your scholarships and grants are more than your tuition and fees, you're, by default, unless you can come up with more qualified educational expenses, you're going to have $13,000 in taxable income. Because this is not going to qualify tuition and related expenses, it means it's going toward your room and board and your personal expenses and other of those personal fees.
Okay, so they don't have to elect it, just that's what happens, is something that becomes taxable income because it's above.
Right.
It's tax-free up to the amount that is.
Only the first 5,000 can be tax-free.
Because it's education.
because this is your tuition related fees.
Yeah, up to whatever's in box one
Mhm.
is kind of your max, plus whatever you add
Yeah.
that does qualify.
Yeah, we would also add books and other, supplies and other stuff.
Right.
So we might not end up with 13,000, but we'd probably end up with at least 10,000 in expenses, in taxable income from the scholarship or grant.
Okay, so generally you wouldn't really be, at a certain point, you're very likely to be maxing out your standard deduction anyway. And so in a scenario like that, you wouldn't want to take on additional tax liability by choice because you're probably nearly maxing it out anyway. Before
Right.
you have to actually
Well,
pay
you might
taxes.
want to take on additional tax liability by choice because of, maybe the credit is worth more than your additional tax.
In a scenario like that where you already have a abundance of scholarship above your qualified expenses, is there a way for someone even to use a tax credit in a situation like that?
Yes, you could still elect, in that case, you could elect to treat the whole 18,000 as taxable income, and you would still have $5,000 in qualified education expenses that you could use it for a tax credit.
So if you choose to elect 13 as taxable, which is kind of what happens anyway, then you're not using the tax credit.
Right.
You have to elect that additional amount that is the actual qualified tuition as taxable in order to get the tax credit on
Yeah.
that amount. Okay.
Yeah, so if this is the situation where we have box 1 is 5,000 and box 5 is 18,000, and neglecting the possibility of additional books and supplies and equipment, you can choose any amount between 13 and 18,000 of this to be taxable.
Okay.
It's always going to be at least 13,000 because only 5,000 of it is going toward a tax-free purpose. So it's always going to be at least 13,000. If it were a little bit different, let's say this was 25,000, you could elect anywhere from 0 to 18,000 of this to be taxable income. If you elected 0 of it to be taxable income, then the whole 18,000 would be tax-free, and you'd end up with a net $7,000 in education expenses. But you could bring this up anywhere up to the full 25,000 in education expenses by electing more of this to be taxable. So that's what this slide is about. If we can allocate certain scholarship proceeds to your non-qualified expenses, making them taxable, but making the qualified expenses paid for with after-tax income.
So right now, as it sits, you got a $7,000 potential
Education expenses.
expenses that you can get a
Yeah.
credit towards,
Mm-hmm.
or by increasing that 18 to from 18 to 25, you like.
Well, basically, you're electing some of it to be taxable, and let's make this,
Because in this
To
case,
make
that
it
18 is
more-
already taxable.
okay, let's say you had 19,000 in tuition and fees, 18,000 in scholarships. So the naive way to do it, and this is the way most taxpayers would do it, if they're doing their own taxes, is they'd say, okay, 18,000 is non-taxable, which makes 0 taxable, which means my qualified educational expenses for purposes of taking a tax credit is my total education expenses 19,000 minus my non-taxable education assistance 18,000 for 1,000 that I could claim as qualified education expenses for purposes of an education credit. So we could allocate some of this to be non-qualified, toward our non-qualified expenses, and then So yes, it does. So the increase in education credit may exceed the increase in tax, in which case it's a good idea to do that. It does affect AGI, so it may have other knock-on effects on the tax return, but we could say, you know, instead of 18,000, let's try 17,000 non-taxable, which makes this, instead of subtracting 18,000, we would subtract 17,000, which makes 2,000 in qualified education expenses that we could claim. But because 17 is non-taxable, that leaves us with 1,000 taxable income, and that would go on the tax return. So by doing that, by doing this kind of allocation, and we can allocate it however you want.
So when box 1 is above box 5, then you can choose any amount from 5 to move it towards your taxable income.
Yes.
When 5 is larger than 1, then that difference is already moving on to your taxable income, and then you can choose to
make more of it taxable, yes.
Okay.
So now we have 2,000 in net qualified education expenses that we could claim a tax credit for. And it may turn out to be that paying a tax on this extra $1,000 of income is going to cost less than the extra credit we get for claiming more education expenses. And in fact, in this particular situation, it's probably almost certainly going to be better to claim that. But this whole slide is telling us that we have that option. We do have to double check that in order to allocate part of the tax-free, part of the scholarship or grant to non-qualified education expenses. The terms of the scholarship or fellowship grant must itself say that it is allowed to be used for room and board or other non-qualified expenses. The Pell Grant does have that stipulation. It can be used for tuition and fees or room and board. So the Pell Grant is not a problem, and that's where most scholarships and grants for at least our clients are coming from. But if they have a private scholarship and it says it can only be used for tuition and fees and nothing else, then we don't have this allocation option. But most scholarships and grants do have this ability. They're called unrestricted grants, and they can be used for whatever purpose the student wants to use them for. Okay, so we'll not go into the examples because we haven't gotten to the calculation part yet. Okay, so now, so everything except for like the rule about what books and supplies count, everything that came before this applies to both credits. Remember, the two credits are the American Opportunity Credit and the Lifetime Learning Credit. So now we're going to go into the rules, especially specifically the calculation for each of the two credits. So for the American Opportunity Credit, this is the more generous one. It's more restricted. It's only for the first 4 years of college. And the amount of the credit is 100% of your first 2,000 in educational expenses. And then 25% of the remaining of the next 2,000. So in other words, if your qualified education expenses let's say are $800, then your American Opportunity Credit is $800. If your qualified education expenses are $1,800, your American Opportunity Credit is $1,800. So the American Opportunity Credit is 100% of your education expenses up to $2,000.
So you can do $2,000 a year and, American Opportunity.
Mm-hmm.
Right. So it's a value of up to $2,000 a year.
Well, that's 100% of the first 2,000 and 25% of the next 2,000. So if your qualified education expenses are 2,800, then your American Opportunity Credit is 2,000 for the first 2,000, and then the next 800 is 25%, and 25% of 800 is 200, for a total of 2,200.
But it caps out at 25, right?
Yeah, caps out at 2,500 because it's only 25% of the next 2,000. So once this gets to 4,000 of education expenses, then it's 2,000 plus 20% of the next 2,000, or 25% of the next 2,000. 25% of 2,000 is 500, and that makes it 2,500. And that's where it stops.
Does someone have to be full-time throughout the entire year, or can they just be like full-time 1 quarter semester?
Well, remember it said 1 semester. And you don't have to be full-time, you have to be at least half-time.
And what if someone's on the quarter system instead of semesters?
Then you have to be at least half-time for at least 1 term. So it's based on up to 4,000 qualifying expenses. The credit is up to 2,500 based on this formula. And then if your adjusted gross income is above the limits, it'll be reduced or eliminated if you're above the higher limit. And then this is split into a refundable portion and a non-refundable portion. The non-refundable part is 60% of whatever your final credit is, and the non-refundable part, or the refundable part, is 40% of whatever your final credit is. Most of our clients are going to get the full 2,500 because college is expensive, and 60% of that is going to end up being 1,500 non-refundable, and 1,000 refundable. And just like a lot of other non-refundable credits, any part that's unused is wasted. There's no carryover.
So, I see, so past 4,000 qualifying expenses, you no longer get any benefit because that maxes out to 500, past the 2,000.
Right. So that's one reason that we don't typically ask people, and parents don't typically ask their kids to save all their receipts, because if college costs 25,000 and you have 2,000 in scholarships, you're already at 5,000. So there's no point in trying to add more expenses on top of that.
So as long as they have 4,000 qualifying expenses above their scholarships and such, then they're already fine. They're already maxed out.
Right.
Okay.
Right. So this this weird computation, this allocation that we saw in the previous 2 slides, we only really do that to try to get them up to 4,000, or up to 2,000. These are the 2 main increase points that we're looking at: is the 2,000, where it goes from 100% to 25%, and the next increase point, which is the 4,000. Those are the 2 critical values, basically, that we're looking at.
Is it usually worth it for most people to try and move beyond the 2,000 up to the 4,000, or is it almost like a wash at that point?
It's often better, but not always, because the credit rate is 25%, which is going to be higher than the student's tax rate, which is almost always 10%. But they may already have wasted or used up all the non-refundable part. Maybe they have a child tax credit and other dependent credit, so their tax is already close to 0. So the refundable part is going to be 40% of 25%. So 40% times 25% is 10%. So that's basically a wash at that point, because every $100 we increase the child's taxable income, increases the parent's credit by $10, but also increases the child's tax by $10. So it's almost a wash at that point. But the standard deduction still goes up because if you remember the rules on standard deductions, and I mentioned that we would learn about that today, but this was like 4 weeks ago. Standard deduction includes, the earned income includes, for purposes of calculating the standard deduction, it includes the taxable part of scholarships that the student received. That doesn't count as earned income for any other purpose, but it does count as earned income for purposes of calculating someone's standard deduction. So it could be that by increasing the student's adjusted gross income, we're also increasing their standard deduction, so they're not actually paying any more tax. So may or may not. So basically, unless you're very familiar with the math behind it, it's usually just better to try different scenarios and see what's going to happen. And if you're going to try different scenarios, well, you could try every scenario. You could say, oh, what happens if we do 2001? What happens if we do 2002? What happens if we do 2003? You're going to take you all season long to do their tax return because you're going to do 2,000 tax returns for one person. That's not the way to do it. The way to do it is, let's try 2,000, let's try 4,000, let's try 0. What's going to be the best? We're going to aim for 2,000 in education expenses. We're going to aim for 4,000 in education expenses and see what turns out best. And I suppose mathematically, sometimes maybe $2,263 is sometimes best, but that's going to be more. That's going to turn out, if that's the case, it's going to turn out more effort than it's worth. And you might save them $12 after doing all that extra work.
So usually you look at 2 and you look at 4, and you kind of
Yeah.
then decide if it's worth looking at something in between.
Yeah. Mm-hmm. I guess the third place you might look is where you get the maximum standard deduction for the student. If you max out their standard deduction, up to that point, up to and before the point where you max out their standard deduction, you're not actually increasing their tax by anything at that point. So that might be probably would be a good third place to look, is wherever you're transitioning from the student paying no extra tax to the student paying some extra tax.
But at that point, you're well beyond the 4,000.
So not necessarily.
Okay.
Because what if we had that other situation where they had 8,000 in tuition and 18,000 in scholarships and grants. So they already have 10,000 in taxable income. And if you add another 12,000, now they have 12,000 in taxable income, but it's still going to be less than their standard deduction, not paying any more tax. So that's your one option. Your other option is if you make 14,000 taxable income to get them 4,000 in net qualified education expenses. Well, now they're over the standard deduction. So maybe you want to go somewhere in between to make exactly $12,950, which is their standard deduction of taxable income, which would be wiped out by their standard deduction. And then whatever that number comes out to be, 2,950, I think, in qualified education expenses. That might turn out to be the best. So yeah, I will add that to. These are our 3 targets. This is usually our first target when we're doing this allocation. This will be our second target, and our third target will be max out. Dependents, the students. Standard deduction.
Have you noticed a lot of students don't even bother filing tax returns?
Until we tell them to.
I wouldn't be surprised a lot of students that aren't working don't think they even have anything to.
Yeah. Well, most students are still considered Alaska residents, so they're still getting permanent fund dividends, even if they're attending school out of state. So they're usually just letting their parents do their tax return. But a lot of students work part-time, so we have to work. So they usually are having. We do dependent tax returns for free. because we want to have control over these, because we want to do it correctly, because if the dependent forgets to check that box that says I'm a dependent, it messes up their parents' tax return, because now their tax return will have to be mailed in instead of e-filed. That's one reason we do those for free. The second another good reason to do this for free is we want to have control over these computations and being able to do this allocation. So I can sit down with the parents and say, okay, look, here are your two choices. You can get a $2,000 refund and your kid owes nothing, or you can get a $4,000 refund, but your kid has to pay $200 in taxes. And they say, well, I'll just pay my kid's taxes and get $4,000. But if the kid was doing their own tax return, then we have to make sure that our tax return matches what the kid did on their own taxes, or get permission to amend their tax return.
Gotcha. All that runaround is more work than the simple math of making another return.
Yeah. Okay, another reason why we may have to, we would actually have to do these calculations and pick one instead of just knowing off the top of our head is because if anyone's in this phase out range, 80 to 90,000, or 160 to 180,000, then they're only going to get part of the credit. So they're not going to get the whole 2,500. They might get 70% of that based on where their income is. It falls in this range. So then instead of their taxes their credit going up by 25%, it might go up by whatever 25% of 70 is.
Would any of the
17.5%.
tax credits and such, would it have any effect on qualified, moving non-taxable to taxable? Would any of that have an effect on the parent's AGI in any way?
No, because that scholarship or grant is taxable income to the student.
Okay.
Right, so it won't affect their parents' AGI.
It can only affect their parents' tax credit, but it doesn't affect their income in any way.
Right.
Okay.
So that is how American Opportunity Credit is calculated, and we're going to have some further qualifications on who can claim these. Let's get this example real quick. So these additional qualifications specifically for the American Opportunity Credit means that first of all, you can only claim the American Opportunity Credit, and that includes the HOPE credit, which was an older tax credit that was available before 2009, which only covered 2 years instead of 4 years. You can only claim this a total of 4 total times per student.
Per social security number.
Right.
But they don't have to be consecutive.
They don't have to be consecutive, but this is, but this can be a problem, especially if the clients don't go back to the same preparer every year, or if the students, start doing their own taxes. Maybe they stop being dependents, but they're still in school, and we don't know whether their parents claim American Opportunity Credit or not. But typically, if you enrolled for school right now, you would start in fall 2023. And your academic years are 2023, 2024. And you would go to school for a total of 4 years, which would be 2024 to 25, and then 2025, 26. And your final year in college would be, you would graduate the spring of 2027. So even though that's 4 academic years, that's 5 calendar years, 23, 24, 5, 6, and 7. So occasionally, especially when someone just starts school, maybe they're taking the minimum, they're taking 12 credits because they're getting into the mode of being a student. Maybe sometimes you might want to refrain from claiming the American Opportunity Credit so that you can get the full amount of the credit later. Maybe their tuition for their 12 classes was only $2,500. And you say, well, you still get a good credit, $2,100, but maybe you want to wait and you can get the full credit for the next 4 years. Or often you won't have any expenses for the 2027 spring tax or 2027 spring semester because you paid for it by December 2026. So even though that is something to consider, I would say in general advise the clients to take whatever money you can get right now. Take it now, unless it's really a tiny amount. Take it now and you won't be able to claim the American Opportunity Credit in 2027. You might have to end up taking the lifetime learning credit that year. And also, because you're doing the 2023 tax return in 2024, and you can't amend your tax returns more than 3 years late, by the time you're actually ready to do your 2027 taxes in 2028, it's too late to go back and change your 2023. So basically, you're going to be locked into whatever decision you made here.
Plus, your income may increase and you don't know if you're going to disqualify at some point, right?
Right. So because of those types of uncertainties, it's usually, in this case, better to take what you can get now instead of trying to strategize around this particular anomaly.
So
itself.
If someone doesn't take a full year load, and instead of getting done in 4 years, it takes them, 6 years, for example, right? They can only claim it in 4 of those years?
Yeah. So, let's see. So let's skip ahead to this qualification real quick. So it says for at least one academic period, beginning in 2022, or whichever tax year we're doing. So if they're on the semester system, that could be the spring, summer, or fall semesters. If you're on a quarter system, you have spring, summer, fall, and winter. But it has to be at least one academic period that begins in 2022. You have to be enrolled at least half-time. And that's defined however the education institution defines it. So in the University of Alaska system, full-time is 12 credits, so half-time is 6 credits. A class is typically 3 credits, so that means you have to be taking at least 2 classes, which doesn't seem like really all that much. But you need 120 credits to graduate. So you could be taking, you could take 6 credits a semester, and it could take you 10 years to finish your 4-year degree. If I remember, there was a restriction on when you applied for graduation, you can only count the credits you had earned in the last 7 years. So they do put a limit on that. You can't just be a student forever. But
you might max it out for 7 years if you wanted to, if you wanted to go slow.
Right. So you may be, you may be trying to work and raise a family and also going to school. So you're taking two classes, and you're trying to, do your degree, and it's going to take you 6 to 10 years to finish your degree. Well, you can claim the American Opportunity Credit for any 4 of those years. They don't have to be consecutive, and you're not required to take the American Opportunity Credit when you qualify for it. You can opt instead to take the lifetime learning credit. So it could be maybe you're a full-time student in your academic year 1 to 2, and then maybe in academic year 2 to 3, you're full-time again, and maybe in your academic year 3 to 4, maybe you're part-time because maybe something happened with your family and you had to take some time off from school or get a job, or maybe you had a kid or something like that. Something happened that you had to move back down to part-time. You're still planning to finish college, but you're just delayed for a little while. And then, but your plan is, you have a plan, so you're 4 to 5, you're part-time, and maybe year 5 to 6, you're back to full-time again, and year 6 to 7, you're full-time and you graduate. Maybe you want to skip the American Opportunity Credit for these part-time years if you're pretty sure you're going to eventually get back to full-time attendance. You know, if you have the full 4,000, there's no reason not to, but maybe you only have like 1,800 in qualified expenses, so maybe you want to skip those particular years taking that credit.
So someone could potentially take the American Opportunity for 4 years and then the Lifetime Learning for another 3?
Mm-hmm. Yeah. So you could take the American Opportunity Credit. It's your choice. You can take the American Opportunity Credit this year, this year, this year, and this year, but then you're locked in. You're stuck with the Lifetime Learning Credit for these 2 years, or maybe you have more expenses and you wish you could have taken the American Opportunity Credit. Or you can take the American Opportunity Credit these 2 years and Lifetime Learning Credit these 2 years and go back to the American Opportunity Credit for these 2 years. But in any case, you can only take it in 4 different years total per student.
Oh, both of them only count for 4 years. You have 4 of one and 4 of the other?
No. The American Opportunity, we haven't talked about the qualifications for Lifetime Learning Credit.
Right.
So the American Opportunity Credit, you can only take 4 years total. And that includes maybe you started school in 2004 and you took the Hope Credit, as it was called back then, and you dropped out, and now you're going back to school. You can only take it for 3 more years because you took it 1 year in the past.
Gotcha.
So that's our first requirement. Our second requirement is you must not have already completed the first 4 years of post-secondary education as measured by the educational institution. So just because you're in school for 4 years doesn't mean you've completed a 4-year course, because maybe you're part-time, or they count 12 credits as full-time, but to really get your diploma in 4 years, you have to be taking 15 credits a semester because it takes 120. So you could take 12 credits a semester, which counts as full-time, but it's going to take you 5 years to finish your 4-year degree. So until you've actually finished and gotten your diploma, you have not completed a 4-year degree.
But you're still limited by 4 years plus 1 year of the LLC.
Right. And it has to be a 4-year degree. So you could take a 2-year degree, which is called an associate's degree at most places, or you could take a 1-year degree, which is called a certificate at most colleges, and complete that and earn your certificate or your associate's diploma, and still continue to finish up your bachelor's, and still be considered not to have finished your first 4-year degree. But let's say you're super genius and you're a dedicated student, you don't have any distractions, and you finish your bachelor's degree in 3 years. You're taking 18 or 20 credits a semester. So you finish your bachelor's degree in 3 years, and you say, you know what, I want a second degree, I want a double major. Well, that 4th year you've already finished 1 4-year degree, even though it only took you 3 years to do it. That 4th year you're not going to qualify because you've already finished a 4-year degree. Or you go immediately on to some postgraduate work, you're now taking a master's degree, or you're going to law school or medical school. That's going to count as you already having finished your first 4 years.
But if someone double major from the beginning,
if you double major from the beginning, you can complete them simultaneously, right? Or what would be smarter would be you finish your requirements for 3 years, but you don't actually apply to graduate, and you just take more classes to finish your second degree's requirements. Because you don't graduate, you have to actually apply to graduate. Okay, and our third requirement, I already mentioned this in passing, but I did not mention the part that you have to be in a program that leads to a degree certificate, or other recognized credential.
So it can't just be a couple classes that aren't towards anything specific.
Right. So University of Alaska will let you, as a non-student, apply for classes and pay for classes. You can just go to class if you want to, as a non-student. But even if you're taking a full-time load, that won't count. You have to be accepted to that school as a student, or in other words, the fancy term they use for that is matriculated. You have to actually be a student, seeking a degree-seeking student, to claim the American Opportunity Credit. And then our fourth requirement, which is, I think is a little silly, but it is a requirement, is that you must not have been convicted of a federal or state felony for possessing or distributing a controlled substance. So these are drug-related felonies. So if you don't have any drug-related felonies, you're fine. You can claim the American Opportunity Credit.
Or if you had your drug-related felony kicked down to a misdemeanor, then you technically still qualify.
Right. If it's a misdemeanor, you still qualify. And it has to be drug-related to disqualify you. So if you're convicted of bank fraud or murder or anything else, as long as it's not drug-related, that's fine. They don't care.
But if you do drugs, you can't go to school.
Right.
Drug-free school zone.
Right.
Although college is where most people go to do drugs.
Don't do drugs, stay in school.
Unless you go to college, then you still get caught.
Okay. I have a big feeling that has, well, this credit didn't even exist before in the 80s, so, but that feels like an 80s rule to me.
Feels like an early 90s rule for me.
Okay. And I hate that we have to ask that question, but for due diligence purposes, we have to ask, has your kid been convicted of any drug-related felonies? I've yet to have anyone say yes, but that's something we have to ask every year. If you were under 24, okay, so this is where we talked about the weird rule where the student can claim their own American Opportunity Credit even if they could be claimed as a dependent on their parents' tax return. And they still have to check the box that yes, someone can claim me as a dependent, and this is the only case in the tax code where we actually care, are you or are you not claimed as a dependent. If the parents elect not to claim you as a dependent, the student can claim the American Opportunity Credit, but in this case, it might not be refundable. So if you are under the age of 24, instead of it being split 60-40, 60% non-refundable, 40% refundable, if you meet these conditions, we'll go into that detail, then it's all non-refundable. And so instead of being 60% non-refundable, it's 100% non-refundable. And this is basically going to be looking at the dependency qualifications through the other side of the lens. So you don't have to worry about this if you're 24 or older, but there are three age categories now for those students. If you're under 18 at the end of the year, if you're 18 at the end of the year, and if you're 19 to 23 at the end of the year. So if you're under the age of 18, and
So you're still in high school effectively at that point, but you might have taken a college credit or something?
that could be, or maybe you graduated early and started school early and you're 17 at the end of the year and you just started your freshman year. That's a possibility. If you're under 18 at the end of, well, these are the 3 different age categories. If you're under 18 at the end of the year, you're always going to fall under this rule. If you are 18 at the end of the year and your total earned income is less than 1/2 of your total support. So that just doesn't just mean your total income is less than half your total support. That means your earned income, means you're working and supporting yourself through work. Or technically, you're not earning enough to support yourself through work.
So say it takes 20 grand to kind of keep you going for the year, and you make less than 10,
Right.
and it's assuming your parents or someone is coming together in half, not other income sources.
Right. So, yeah, support includes things like rent, food, entertainment, education, clothing, transportation, and utilities. So this is basically the categories that count as support. Education is one of those, and if you're in college, then your tuition is part of your support. However, when we're testing the support test, including in this case, tax-free educational assistance doesn't count as either side. It doesn't count toward the parents providing support, it doesn't count toward the students providing support, and it doesn't count toward third parties providing support. So tax-free assistance actually reduces the denominator, if you will, of the total support. So rent and food is going to be the main thing. So if your apartment is $1,000 a month and your food bill is $250 a month, so you're living fairly frugally, 12,000, that's 15,000 total. And then, bring it up to 18,000 to include clothing and transportation. So if your part-time job pays you more than 9,000 during the year, then that's more than half of your support. And then you won't be caught by this rule. So we would have to worry about, what support is. Do they have their own apartment, between semesters, or do they come back and live with their parents? So are their parents providing some of their support or not? So that's our second age category, is if you're exactly 18. And then our third age category is if you're over 18 and under 24. So in other words, your age is 19 to 23 at the end of the year, and you're a full-time student, and your earned income is less than half of your support, you're going to fall into this rule. So that means if you're 19 to 23 and you're a part-time student, you don't have to worry about this rule. But if you're a full-time student, we have to check your earned income. Okay, so this is kind of like an age test, and then, so if you fall under any of these 3 categories based on your age and your earned income, and possibly your full-time student status, and at least one of your parents is alive at the end of the year, and you're not married, filing joint. So if you meet all 3 of these qualifications, so-called qualifications, but really disqualifications, then your refundable American Opportunity Credit turns into a non-refundable American Opportunity Credit.
So it doesn't change you getting the credit, it just changes what part is refundable.
Right. And so, because of this, it's often going to turn out not to be worthwhile to let the child claim their own American Opportunity Credit. Because if we're deciding should your parents claim you or not, we've already decided that the parents are eligible to claim you, which means you're not providing more than half of your support, which means that in at least these first 2 cases, you already fall under this rule. And if you're a full-time student, you're automatically going to fall under this rule. So because of this rule, it's often not much of a benefit to let the child claim their own American Opportunity Credit. You know, unless the parents, you know, their income is too high, they're not gonna get a benefit anyway.
But if the student supported over half of their own support,
Mhm.
they were,
They wouldn't be a dependent.
okay, so at that point, they don't get any poor benefit out of claiming themselves or using it themselves, right? If say they're,
Well, they would get, you know, if they did pay more than half of their own support and they're at least 18, then this rule would not apply to them and they would get the refundable and the non-refundable part of the American Opportunity Credit. But in that case, there wouldn't be a choice involved because a student wouldn't be a dependent in the first place.
gotcha. Generally speaking, it's your best net between parents and kid total is for the parents to be covering at least half of the support, and for the student to maintain that dependency, that dependent status up
Yes,
through
that's-
max 24 years, right? Or 23 or 24 hours.
Age 23 or whatever they graduate, whichever comes first. But yes, that is going to, but their life situation doesn't always follow like their optimized tax situation. So if we had a choice, then we would like usually to have the parents claim the college age student as a dependent. But sometimes we don't have a choice because we need to look at the support test.
But if you're already 24, then it doesn't matter if you support yourself or not. At that point, it's all on you.
Once you're 24, if you're 24 or older, this rule does not apply. This rule only applies if you're under 24.
And even if you're only halfway through your college program, if you're already 24, then your parents don't get any benefit off of you.
Your parents can't claim you as a dependent
Okay, so
unless you're disabled.
they can't use that educational benefit for you. You have to use it yourself.
Mhm.
They don't get all the other dependent credits at that point either.
Right. Because you're simply not a dependent. You're too old.
So at that point, if someone takes a year off and then goes to school,
Mhm.
their parents are going to have like a $5,000 plus potential overall tax benefit reduction by the student waiting a year to go to school.
Well, let's say you graduate. Let's say you graduate the year of your same year as your 18th birthday. So you go to school and you'll be at 19 at the end of that year. And so you've taken a year off, and so you'll be ages 19, 20, 21, and 22. So you'll still be able to be claimed as dependent all 4 of those years.
Oh,
Even if you take 2 years off.
so 24 gives you actually some wiggle room.
Yeah, 24 gives you quite a bit of wiggle room. So if you don't start college until you're 20, 2 years after you graduate high school, you'll still be able to be claimed as dependent 3 more years.
Okay. And if you take a year off and you're traveling or doing whatever before you actually start school, your parents can, as long as they're providing over half of your support, can still claim you and get all the tax benefits, correct?
Yeah, the $500 other dependent credit.
Oh, that's right.
You're not going to be a qualifying child if you're not a student and you're 19 or older. If you're 18, you'll still be a qualifying child because remember, under 19 or a student under 24. So if you take a year off and you just bum around or go on a lot of vacations, you'll be, if you're 18, you'll still be a qualifying child. If you're 19, you're not a qualifying child. So the parents will lose those benefits. And remember, your students under 24 are also qualifying children for earned income credits. That's something to consider as well. And they're qualifying people for head of household filing status. So whenever there's a choice, if possible, it's almost always better for the parent to claim the child.
Okay. But you're saying, because qualifying, what was it? One of them, once you hit 18, you lose the benefit, right? Child tax credit, I think it was.
Yes,
17.
and it's 17. Remember, the child tax credit is a qualifying child under 17.
Oh, under 17.
Yeah.
So 16.
Yes.
Once you hit 17, you lose that.
Yeah.
And then all that's left is your other, you can be an other dependent at
Mhm.
that point. And besides that, it's really just EIC calculations and education credits and such.
And head head of household.
Head of
Status.
household.
Mhm.
Okay.
Yeah, remember the benefits are child tax credit or other dependent credit, additional child tax credit, earned income credit, head of household filing status, and child dependent care credit. And now we have American Opportunity Tax Credit. And, well, once you're 17, you lose that when you turn 13, and you lose this when you turn 17, but you still have several benefits that you can claim for a qualifying child dependent. This one doesn't have to be qualifying child, it can be qualifying any dependent child or relative. This one can also be qualifying child or qualifying relative, both, and this one can be qualifying child or qualifying relative, but this one is only qualifying child. And remember that EIC is several $1,000s all by itself, potentially. So if you're a parent making let's say $30,000, and you're a single parent and your kid's in school, you still want to claim them as dependent because you're going to get this pretty generous earned income credit, as well as American Opportunity Credit. Okay, so here's an overview, and that's just going to summarize what we've went over in the last hour or so. And finally, we'll talk about the lifetime learning credit. Okay, so the lifetime learning credit is more flexible, it's available to more people, but it's also at the same time a little more restrictive on what expenses you can claim. Remember, your educational expenses other than tuition and fees have to be paid directly to the qualified institution to count as educational expenses. And this credit is based on, it's not the amount of the credit, but it's the amount that is based on, up to $10,000 of expenses. And that is combined for all eligible students. So any students that you're not claiming the American Opportunity Credit for fall into this bucket.
If you have two college age, like a married couple college age,
Mhm.
right, where they would, I mean, at that point, they're filing a joint return potentially, right?
Mm-hmm.
They'd be limited to just half the benefit of them individually if they were married at that point?
You get up to 10,000.
Yeah. So if they had been single and never married, then yeah, they could each claim $10,000 in education expenses.
But if they're married now, they only get,
Up to 10,000.
Yeah, up to $10,000 for the
So
entire
if
return.
your education is 10,000 and mine's 10,000, and we're a couple, we can only claim 10,000 on them. You don't claim 20 or 5,000.
right, if you're under 10, then it doesn't matter.
Right.
But if you're over 10, then you're not able to claim some of it, usually this one,
Right.
if you're a married couple. If you were a young married couple, can you get the full benefit of the American Opportunity Credit still?
Mm-hmm. Yes. So remember, the American Opportunity Credit is, based on per student. And the lifetime learning credit it's capped per tax return.
And that one, if you did get married while still in college, at that point your parents would simply miss out on their child tax credit and such.
Yes.
Or
Once you're married, if you end up filing a tax return, your parents can't claim it as a dependent.
Right, so they don't get the other dependent credit or the EIC calculation.
Right.
Or the education credit, because now you would be taking it.
Mm-hmm.
The moment you're married, you kind of, gotcha.
Yeah. And that did happen to one of my clients where their daughter got married without telling them.
So in a scenario like that, say you get married
Mm-hmm.
in August,
Mm-hmm.
at that point, does that married couple, do they still file independent returns that year, and then the following year they do
No.
joint?
No. Remember back to chapter 3, your marital status on December 31st is your marital status for the whole year. So if you get married in August, you were married the whole year for tax purposes.
Gotcha.
And if you get divorced on August 1st, you're single for the whole year for tax purposes. So it only matters whether you're married or not as of December 31st of the tax year. Okay. So the credit is based on up to 10,000 of qualified expenses combined for all eligible students. So we're going to exclude any students that we've already claimed American Opportunity Credit for. So all of the rest of the students in your household combine their expenses, and your credit is 20% of the combined expenses.
Up to 10,000.
Yep, 20% of up to 10,000, which makes the maximum credit 20% of 10,000, which is 2,000 per return. So this credit is 2,500 per student. And this is 2,000 total credit per tax return, regardless of the number of students. And these can be mixed and matched if you have multiple students. So maybe you have 3 kids, ages 19, 22, and 25, all in school. And let's say this person is taking the American Opportunity Credit. Maybe they're a freshman. Maybe this person is a senior, and they're taking the American Opportunity Credit. And this person is in graduate school. And so you'll take the lifetime learning credit based on this person. And maybe your wife is also in school, maybe part-time, just taking some classes to help her job prospects. That would also be lifetime learning credit. So these 2 students would be combined for purposes of the lifetime learning credit.
What if the third and fourth one, right? What if their expenses only total like 5,000? Could you then count expenses that you didn't get an opportunity credit for the full max, or basically got maxed out on opportunity credit for student 1 and 2? Could you count those expenses that didn't get counted towards it for the combined total of 10?
No.
No?
No. If you're taking the American Opportunity Credit for this student, all the expenses for this student are used up in the American Opportunity Credit. So even if this student had 20,000 in expenses, you don't get to count any of the expenses for lifetime learning credit.
You can't count that surplus pass for the next student in terms of, even though they're a separate social, to increase those that total expense of that one.
Right.
Okay.
So only these students are combined because you're not claiming American Opportunity Credit for them.
But in that case, since it's per return on those other 2, if one had 9 and one had 1,000,
No.
you could. It doesn't matter.
If this one had 9 and this one had 1,000, you would get 2,500 plus 1,000.
No, I mean for students 3 and 4.
Oh, this is per return, so this would be combined. So if this person had 9,000 of expenses, and this person had only 1,000 in expenses, that would be combined to the 10,000 total. So we're excluding, for lifetime learning credit, we're excluding any expenses paid for the students who take the American Opportunity Credit. But we combine all the expenses for the students who don't take the American Opportunity Credit. Okay, we have the same income limitations and phase outs as for the American Opportunity Credit. And this is a non-refundable credit. So often, especially when we have dependents, you might not even see any benefit from this.
Oh, because your CTC and AOTC, all those kind of cover you already.
Yeah,
So-
if your other non-refundable credits already reduce your tax to 0, this won't give you any additional benefit.
So it really helps if someone has a bunch of dependents to actually have a business or something where they're gonna owe taxes.
No,
No, or-
because the self-employment tax is considered an additional tax, so it's calculated after you've taken your non-refundable credits into account.
Gotcha. So none of these credits help you with that anyway.
Right. The refundable credits, non-refundable credits only help you with your base income tax, your basic income tax, not any of the other taxes.
Once your tax is zero, the non-refundable credits don't help.
Right. The only exceptions are there are some credits, non-refundable credits that carry over, and the ones that we discussed that do carry over from year to year are the adoption credit. I think that's the only one we've considered so far.
So I guess if someone wanted to max it out, if they needed to sell something and recognize a gain or something like that, you have all these
Yeah,
credits. That
if
might
you
be
had a way
against
to generate taxable income so that you could actually make use of these otherwise useless non-refundable credits, then great, go ahead and do that. And that might be something we could advise someone if they came in ahead of time and let us know about that situation. Once December 31st has passed, it's kind of too late to plan ahead. Okay, so our eligible student is a lot more generous. You only have to take any courses at an eligible educational institution, one or more. You have to be either in a degree program or acquiring marketable job skills or improving job skills. And there is no limit on the number of years.
How does this affect students that do like a semester abroad, or they go to a different country for school for a year?
In general, they're going to pay their tuition to not the host in these foreign exchange programs. I believe that they generally pay their tuition not to the host country, but to the originating country, who then helps cover the expenses of an exchange program. But if you're not talking about an exchange program, like if someone is like going to go to Oxford or any other educational institution outside the country, I'm pretty sure that they will not qualify for any of these credits because the federal financial aid system does not subsidize that.
Gotcha. So my brother was looking at like a program in Ireland for tax, or not tax, what's it called, coding. But he's my age, he's already got a BA. So if he did that out of country, he has no potential tax benefit from it.
Right,
But
because
if he went
you're
to-
not going to get a Pell Grant for that.
Well, I mean, he's already got a bachelor's, so I don't think he'd get a Pell Grant no matter what.
Right, but if that school is not eligible to participate in U.S. federal financial student assistance, then they don't count as an eligible educational institution for the purposes of these credits.
But if he went to any institution that does count within the state or within the country, then he could potentially use a lifetime learning credit to offset some of those costs, right?
Yes.
But if he goes overseas, then you miss out on that. Hopefully,
Yeah.
you've got enough benefit from being overseas to make up for it.
Mm-hmm.
Okay.
Okay, so here's Brian. He goes to culinary school, and it turns out that that is an eligible institution. So his $2,400 of expenses count toward his lifetime learning credit, and his lifetime learning credit is going to be simply 20% of that, $480. Okay, here's Carl. He spent $1,400 in tuition for his class or two at higher ed university, and he paid $200 for books that he bought from the school, but he also bought additional equipment and supplies from Amazon for $800. This $800 does not count for lifetime learning credit, even if it's a requirement for class. So that's going to be $1,600 in expenses, and his lifetime learning credit will be 20% of that, or $320.
But if you bought like a laptop on Amazon, for example, and it is required to have one to do the class or
It does not count.
it still doesn't count.
No, it doesn't count. Remember, for American Opportunity Credit, it doesn't matter where you bought them from, if they're required for school, for class. For lifetime learning credit, they only count if they're purchased directly from the institution.
So if you go to the bookstore and you buy a laptop there,
Yeah,
then you could potentially count it.
yes, if it's required for class. Okay, so here's Darlene and Tom. They're married. Their dependent son is in their 5th year of college, and they've already claimed the American Opportunity Credit 4 times. So their son is no longer qualified for the American Opportunity Credit because it's been claimed in 4 prior years. And then both Darlene and Tom also take classes at the local community college, improving their job skills. So let's just add up all their expenses. Tom, $1,800. Darlene, $1,450, and their son, $7,476. If we add that all up, hopefully they've done that for us, it's $10,726. But because of the cap, they stop at $10,000 and they get the maximum credit of $2,000, 20% of $10,000. Okay, and here's our double benefit. Like I mentioned before, you can't claim both credits for the same student in the same year. If someone finishes their fourth year of college and goes straight into grad school that same year, they'll be considered undergraduate for the whole year, because if the question is, did you finish your 4-year degree before the beginning of the year? And they wouldn't have. So someone might qualify for the American Opportunity Credit, but you still can't take both credits. Okay, and there's a quick helpful comparison of the 2 benefits. Chapter 10, page 314. Which credit to choose? Well, generally, you almost always want to claim the American Opportunity Credit if it's available. If it's a very small amount, maybe you want to skip 1 year, especially if you expect to be able to take it in 4 of the future years. Here's a 1098T again. If you want to claim the credit, these credits are claimed and computed on Form 8863, where we have an example on page 317. 8863 is 2 pages. The first page is parts 1 and 2, and then the second page is part 3. And actually you do part 3 first. You do part 3 for each student. This is on page 317 now. You do part 3 first because if you have more than 1 student, you'll do part 3 multiple times. But then you'll add the results from all of your part 3s to complete parts 1 and 2. So here we can actually do a quick little tax return. So this example, if you want to follow along after I move the slide, is on page 316. So we have Elaine, her AGI is 49,000, and her tax liability is 3,262. So they've already done some of the work there for us. If we just want to double check that, 49,000, what do we think her filing status is going to be?
Helpful.
Yeah, I agree. So 19,400, which will be taxable income of 29,600. And if we look that up, in our tax table. So that's earned income credit.
$29,600. So
3256. No,
3262.
oh yeah, that was the wrong one. 3262. So, okay, that checks out. Okay, so she has qualified education expenses for her son David, a college freshman, and she takes some classes at the local college to improve her job skills. Okay, she chooses American Opportunity Credit for David. He has tuition and fees of $7,400. So, David, $7,400. Qualified education expenses. And because it's more than 4,000, we're not going to ask about any books or supplies because we're already past the limit. And then she does not qualify for the American Opportunity Credit. She's not in a degree program, or maybe she already has a degree. But her expenses are $1,200. Which makes her credit $240. Okay, so the next couple slides are going to show how to fill out the 8063. I'll let you look at those on your own, but we're going to also do, might as well do the rest of the tax return.
But in this case, it looks like she's still gonna owe tax no matter what, even if part of it is
Yeah,
refundable,
doesn't say,
like you're pointing out.
No.
yeah, it doesn't say what her withholding is, so let's just make up a number. Withholding 3,500, just so we can actually have enough data to do a tax return. Okay, so if we were actually going to do a tax return, we could do it on, we would need a 1040, obviously. We would need Schedule 3, which would be for tax credits. We would need Form 8863 for the education credit. And then if we're doing a tax return for money, we'd also have to do Form 8867. But instead of doing all those, I'll just note those. We'll need a 1040, we need a Schedule 3 for tax credits. We need 8863 for education credits, and we need 8867 for due diligence. So those are the tax forms that would have to be attached to the tax return. And from her, in order for us to do her tax return correctly and follow our due diligence requirements, we would need a W-2 and we need a 1098-T from David, and we need a 1098-T for Elaine. And we're assuming that her only income is from her job. So these are the documents we'd require, these are the documents we would prepare. Okay, so wages and other income was $49,000, and we already did standard deduction of $19,400. So I'm just abbreviating the 1040 again. And so taxable income was $29,600, and tax was
It would be 19,000. Or no,
no. Tax was, what was it, 3262, wasn't it? Not 3260.
3262.
30, yeah. Okay. So we recopied that. Okay, so basically, these three lines will be spread out through the entire first page of the 1040. This would be like line 1, this would be like line 15 or something. This would be the first line on her second page, tax, and then non-refundable credits. So, let's see. So we have American Opportunity Credit for David. Well, his expenses are already more than the max,
So it's
So,
like 2,500.
2,500, which is split 60% and 40%. So it's 1,500 non-refundable and 1,000 refundable. And then this American Opportunity Credit is 240 non-refundable. So her total non-refundable credit is 1,740. So we'll include that non-refundable credit. And is there another credit that I'm missing?
She doesn't get the earned income credit, dependent credit,
Yep, the dependent credit. So
500.
So 1,540, is that what I said? 1,740.
740.
And a $500 other dependent credit. So these are going to both be minuses. So 2,240 from that is 1,022. Let's go ahead and carry this up to the next line. So her net tax is $1,022. So that's not her tax after credits. And now we have withholding and refundable credits. Her withholding, I just arbitrarily decided was 3,500. Her refundable credit is just $1,000 for American Opportunity Credit. She gonna qualify for earned income credit?
No, she made too much.
Right. Her income is too high.
No qualifying child.
Yeah, one qualifying child, but
He wouldn't qualify for the earned income tax credit, would he?
yeah, as long as he's under 24 and a student, that's the age test. And then relationship residency. Okay, so 49,000. Let me check that real quick. I'm pretty sure you're right, but I'm just gonna check it. Oh yeah, way too high. Okay, so no earned income credit. So total payments then, so remember refundable credits count as payments, and her refund would be the difference between that and that.
3478.
Right. So she'll get a $3,478 refund.
What? So she's getting 35, because the credit effectively took care of her taxes. Most of what she's getting back is just her withholding in this case, right?
Yeah. Yeah, if she had no, so hypothetically, if her withholding was 0,
She would owe $22.
she would owe $22. Also, hypothetically, if she did not get to claim either of these credits, well, if she didn't claim any credits, she gets a dependent credit. This 3,500 I picked because it was pretty close to 3,262. So she would get a $740 refund. If she didn't have any education credits, her tax would be $2,762. Her withholding would be $3,500, and so she would get a $738 refund. So she's still getting, $2,740 more in her refund than she would have without these credits.
So I'm kind of thinking back to like the parents and what they should be covering for their students to maximize the tax advantage. They should basically be covering all or most of the tuition, and it sounds like over half of the general support.
Right. Yeah, they have to be, the student has to not support themselves in order to be independent.
Right, they have to be a student and not.
So they have to provide less than half of their support, right?
Right.
But how about from a tuition standpoint? Is at that point it's just a matter of
Education is part of support, so tuition is part of their support, but only the out-of-pocket tuition. Any tuition that's covered by a scholarship or grant does not count as support either way.
so if they got a $4,000 surplus, the student, beyond their scholarships or beyond what the tuition was.
That part, because it's taxable, would count as the student providing partially their own support.
Right, that'd count towards the student and their support. Okay.
Yeah. Okay. So I didn't get to chapter 11 like I planned, but I do, oh, it's already 8 o'clock.